Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
Hey guys, welcome back to DeFi by Design. I'm really excited to have our next guest on the podcast. His name is Jason Wu. He works over at DeFiner, which is a really innovative new lending protocol. And they contribute to the DeFi space in a less traditional kind of way. They're not a traditional DEX or decentralized exchange. And at the same time, they're not a centralized exchange. So they operate kind of in the middle, and they help facilitate the interactions between centralized finance and decentralized finance. So I'm really excited to have Jason on. We also have Andrew on today. How's it going, Andrew?
What's up, guys? I'm doing well. Just hanging out, staying alive, and excited to talk about some DeFi stuff.
Yeah, same here. All right. Well, are you looking for anything in particular here from Jason, Andrew?
Yeah.
Or,
Hey, Jason, if you'd like to give our audience a quick intro about you, kind of what you do at DeFiner, your background, that would be great.
Hey, guys. Yes, absolutely. It's really nice to be here, and let's talk about DeFi and what we are doing. So at DeFiner, as Rob introduced, we can find a balance between centralized and decentralized service because we believe, there's a necessity to do like KYC and know more about your clients, this kind of thing. The reason for that is we cannot really bring the DeFi solution to the real economy without this, because in the future you will have the regulation concerns. So that's kind of a unique side for the DeFiner. And the DeFiner is decentralized. We're still decentralized, right? All the transactions, loans, lendings all happen on the smart contract based lending system. So we are decentralized lending protocol. And currently we have two services. One is specific for business, and that's the one I just talked. We have the KYC and help you, the customer, know more about who are the borrowers. Another side, we have the DeFi savings account, which is totally without KYC, and it's very similar to other like DeFi protocol, but we did a lot upgrade and to improve the capital utilization rate. So that's the generally two product we are offering to the market. And I'm so happy to be here and to talk more about the DeFi and what's going on, to happy answer any questions you have, Andrew.
Awesome. Yeah, man. We're excited to have you in. And I don't think there's a better or more interesting, challenging to talk about the Ethereum gas prices. So recently, we've seen a big uptick in the price of Ethereum overall, and with that has come some insane prices in gas. So with you and the team overall, what are you guys attempting to do to push that and solve that for your users and overall for the usability of your platform? How are you guys working on the gas rates?
Yeah. The gas is insane high. That's all because, we are all looking for the Ethereum 2.0 and improve the throughput of the blockchain. However, right now, the DeFi protocol is so popular and a lot of users on Ethereum right now, and that's drive the gas price go very high and crazy high. And how are we going to solve this problem? If you hear about meta transaction, and which means, the project itself can pay the gas for their users. And that's something DeFiner is working on. How it typically work. So usually you need to have a proxy smart contract, and this proxy smart contract can interact with a relayer, and in the relayer it will pay the gas for the user, whoever sent the execution orders to the proxy contract. So it's very safe, and because it's still 100% owned by the user, but it gives the project like DeFiner a way to pay or compensate some portion of the gas for the users. I see this is very important for a lot of new users. For example, if you don't know Ethereum, right? Like whenever you want to use DeFi, you need to have Ether first. That can cause a lot of trouble for a lot of people who are new to this field. So this meta transaction and is very helpful to solve these problems. then it gives the project a way to control the price of the gas. And then the user, they just don't need to worry about that. So that's how DeFiner is going to solve this problem.
That's really interesting. And it kind of brings up a question in my mind. For people that are a little bit newer to Ethereum and DeFi, they come to DeFiner and they're asked to enter their email address, which is a little bit different from a lot of other DeFi protocols. And, it seems like these additional customer departments allow you to do some interesting things, like pay the gas and provide some customer service. What was the thought behind providing that customer service rather than a fully decentralized program where, you connect your MetaMask and you're operating with the blockchain, not so much with an individual or group of people?
Yeah, that's good questions. And first, we still have the fully decentralized product, and which is the base layer, is the trust layer. And another layer we are adding on is the user management referral program. And that layer is kind of typical for the centralized world, right? Like Google, Twitter, they all have that. So the reason why DeFiner want to bring that is we do believe it's always about community. And we think the blockchain, the most useful way is build the trust between lender and borrower for the financial transactions. However, besides that, the users still need to figure out a way how can they get connected with each other because it's a community. I will just give you an example, right? If you have a loan, like it's going to either expire or it's going to trigger liquidation. But you are so busy, there may be like 1,000, 2,000, you don't care about that much. And if it is truly decentralized, without any, the user management system, you probably will lose money or cause loss, right? So in DeFiner, we will send you the notification email to remind you, hey, Andrew or Rob, you have a loan, you better refill some collateral, or you better to, pay more attention about that. In this way, it can avoid the loss of the user. So in DeFiner, we put the user experience at the also very high priority. So we believe to protect the user's fund, the security is the most important one. So with this like user management system, and user can have a better experience to use the service. Also, we are going to make it as optional. So which means for the typical DeFi users, if they don't like this, if they just don't want to sign up, don't want to submit this, that, they not have to. So it's optional. But for other users, and if they want to get more service from DeFiner, like get notification, participate our referral program, we recently have the token. They can participate token liquidity mining by contributing to the lending, borrowing. But in DeFiner's mind, the community, the user can do more, right? If they love your service, they can promote your service. So those people also should be incentivized, which other protocol they cannot do that. So in DeFiner, they can also achieve that goal, like mining some coins from DeFiner by referring to the friends, right? And then friends refer to other friends. So if it's optional, if they want to participate the community and earn more tokens, they definitely can sign up, provide the information, and participate in the referral program. Also get notification, all this add-on service. So we think it will help user to better use the product. So that's just one angle. Another angle is in DeFiner, we are also going to provide like a little bit long-term loans, because right now, if you see the DeFi loans, it's very short-term. There's no long-term loan. But if you see the overall financial system, the traditional one, the majority loans are the long-term loans, right? Over a year, over 10 years. And the current setup in DeFi, they just cannot do that because the price volatility is so high and they just cannot predict the risk. So they cannot provide a loan over a year. In DeFiner, we always think DeFi is not only for the blockchain and cryptocurrency, but it should also bring this DeFi solution to the traditional financial industry. So which means we want to help the small medium-sized business. Some businesses like DeFiner, they are in a seed round, Series A or Series B. Their stock equity is very valuable, but a lot of time they cannot get a loan very easily, right? So we want to provide a service, help those business customers to do the KYC, to present themselves, just like the Republic, and they can present themselves. They can use their equity or unissued, the equity as collateral, and then we can help to verify that and use that as a collateral and issue the token against that collateral, and then they can do the crowdfunding through the the note, or a little bit longer, between 1 year, like typically 2 years notes. They can issue the notes and very easily through the DeFiner platform. So that's another angle why we are going to have this kind of user management system. The major reason is first, it's kind of help the community to grow together and more connected with each other. Second, we want to provide more business solutions and to provide a crypto crowd borrowing platform and for business. Then you need to verify the business profile, all these things. So that's the major reason behind it. And but at the same time, it's optional and it's still truly decentralized, because the transactions there is all, the underlying layer is all decentralized. But we just on top of that offer an option for the users. Yeah, that's the major reason.
Yeah, and I really like that as a concept, just because over the past few months and year or so, the whole space of DeFi and yield farming and lending and borrowing, it's all really come to a whole and come to fruition. But the one thing that's stopping anything from really getting, mainstream is just like the overall level of competence that one needs to be able to go into these protocols and use MetaMask and pay gas fees and transfer among wallets and lend and borrow and not get liquidated and understand what you're doing and why you're doing it and how you're doing it. It's not exactly easy for the common folks. So that's one thing that we're real excited about as far as the whole Ethereum community goes, is bringing the concept of yield farming and lending and borrowing into the masses in the easiest way possible, kind of like a bridge from the normal world to the DeFi.
Yes, that's exactly what we want to do. So because the normal world, right? They are familiar with all these user login, system management, all these things, and but the DeFi they just don't have that. That's why we find a middle level solution to just want to expand the user base for DeFi, and even for the yield farming is very popular recently, right? I think it's majorly also driven by the craziest yield, right? The APR or APY, it has like 100%, 30%. It's very crazy. However, like if now we're talking about yield farming, one thing I think everyone should pay more attention is what's the interest rate you borrow money, right? If you borrow USDC on compound or DAI, what's the interest rate right now? Right, it's still very low. Like for USDC, like 2%, DAI like 5% USDT, around that range. Think about that. Why people, from another side, they keep telling you the yield farming is like 100% APY, but the USDC you can borrow 2%. It doesn't make sense at all, because in the financial system, it's all connected together. If there's a real high yield, the money, people will borrow money from the low cost capital and invest in the high returns, right? But I didn't see that happen. And in this yield farming, right now the majority returns came from the appreciation of the token, the governance token or the yield farming token itself. That model is just not very sustainable. It's kind of more close to the earlier adopters or participants, and they will gains from people who are going to come later and buy those tokens. And it all depends on the appreciation of the token itself. So it's not a sustainable model, and maybe it will only exist for a new project for several months or even shorter. But it's definitely not sustainable. Otherwise, you will see a lot of capital, from the low cost like compound maker will be borrowed to do that. So, but I didn't say that. So it's in my opinion, it's just not very sustainable if you relies on the yield return solely because of this token. Because the token price can go very crazy, right? Like whenever people want to buy the token, you cannot predict the price. So that's what I'm thinking about this yield farming.
Yeah, and a lot of these tokens are governance tokens, obviously with the idea to be able to vote on proposals, especially with the urine finance. But the one thing that a lot of people are holding out for, and I would say that is to be expected from these tokens, is eventual sort of a dividend payout in terms of cash flows from fees that are accrued on the network. So this would be a super, super interesting growth phase of the development of these tokens that are just a simple governance token right now. But yeah, it's most definitely, these high API yields, it's going to be tough to sustain them over time. Like I remember when Compound was fresh out with adding BAT to the protocol, there was like 25% APR or APY, and that quickly dwindled down to like 1% within a few weeks. So the opportunities come and then they go, but the concepts still lie strong, which is super important.
Yes, yeah, I think like yield farming, if we compare it to the traditional financial world, it's more like the fund manager or the hedge fund manager. Like they kind of just overall the whole market and looking for the high yield opportunity. Yeah, but from technology side, the coding requirement is not that high. So which means they don't have technology barrier, but it's definitely an innovation. So the first player become very popular, but it's easy to replicate. Also, you see the yield farming phase 2, right? And by the Chinese community, it's just not that sustainable, but it's very good innovation, because I compare it to the more like a fund manager level work for this recent yield farming.
So Jason, you mentioned how this rally looks like it isn't the most sustainable, and that's a popular comparison. People are comparing these really large interest rates to some of the gains that we saw in 2013 and then also in 2017 with ICOs. And not just the interest rates, like you mentioned, the token prices really multiplying in value. And something DeFiner is doing is offering those longer term loans, maybe to make DeFi and crypto a little bit more sustainable. So, you mentioned longer term loans. We also talked a little bit about under collateralized loans. Those are two things that are really important in this current system of credit, because people have a credit score. Normally what they're looking for is some sort of under collateralized loan where they don't have to provide too much collateral. But it sounds like DeFiner is kind of changing the game by allowing companies to collateralize their equity and get a DeFi loan that way. So could you explain that process a little bit? That's really where DeFiner is starting to mix centralized finance with DeFi. So does that loan still exist on the blockchain? Kind of how does that process work?
Yeah, for sure. So for under collateralized loans, it definitely more risky, but higher returns. But in my opinion, all the loans has a collateral. Either the collateral is a asset, right, which is they call it over collateralized loan, because the asset can be easily liquidated and sold on the market. Another side is the asset like not that easy to be liquidated. Let's kind of sit in the middle between over collateralized and under collateralized. And for that loan, the current market is like 15%. Like that's the APR. Because I know there's a lot of mining companies, they are borrowing money against their mining machines. That's kind of, the mining machines is not that, liquidity is not that good compared like Bitcoin or Ethereum. So that rate already being like 15%. So if we're talking about solely credit loan, right, that means based on your personal credit. So that's in the another end, is that's kind of the under collateralized loan we are talking about. In DeFiner, we believe we can tokenize a person's reputation. Just right, if you remember the news, like the NBA players, he tokenized, his career income and use that issue the token and to raise the debt, right? The idea is, the idea is very similar. Like let's say Andrew, so he's successfully run the DeFi in the community, Twitter, all these things. That's actually his asset, and he can he's a key opinion leader. He come to the DeFiner platform. He check, hey, the DeFiner, he submit the application. I'm Andrew, this is my credibilities, and people know me, and I have asset, which is the, the social media account I'm currently running. Then after we assess all that possibilities, all this information, yeah, Andrew, this is the real Andrew, and do this, that. And then we can issue tokens against this person, right? Just Andrew. And Andrew said, I want to borrow like $100,000. And this is, the asset I have. Right now, you cannot sell it, right? Like, but that's really your asset. And if, you default, that will damage your reputation. Probably you don't want to do that. So in this way, we see the default rate will be also very low. And if Andrew default, the asset he bring on the table, which is all the, the social media, all these social assets, can be claimed by the community. So that's kind of give you an idea how we want to approach the under collateralized. Though it's not truly under collateralized, and because if someone do not have anything and to use that collateral, and they have no incentives to pay back the money, right? Even the traditional world, the credit card, right? All these things, like if you default, you will have bad recording credit history. You cannot get another loan. I think we want to apply the similar idea to the DeFi. Like, can we bring the real world, the use case to the DeFi world? Because in my opinion, the most valuable for DeFi is handle the transaction and build in the blockchain. Like no one can alter it. But then based on that, that's the core. And based on that, we need to extend to the real world. And non-collateralized loan is definitely is necessary for a lot of people. And also that will boost the the total wealth or asset under managed for DeFi a lot. And that's the reason why at the beginning we start to collect some user informations, but it's optional. So that's all tangled together.
That's really interesting. And you mentioned reputation and bringing in that idea from centralized finance or a lot of or pretty much any system where you want to disincentivize that bad behavior of defaulting on a loan, right? That brings in this concept of reputation. Something that comes to mind right away, also because Andrew mentioned sharing fees, is the idea of prediction markets. And I'm not sure if you have much or any experience with prediction markets, but I think it ties into ideas that we're saying is incorporating kind of a fee sharing program on these protocols, and then disincentivizing bad behavior with that measure of reputation. And prediction markets don't have a lot of activity right now, but it seems like they could encompass a lot of this activity in finance. Especially it might be around betting more than lending and borrowing. But what's your take on prediction markets? Do you see them as viable for any period of time coming up?
For the prediction market, I believe there's a big the use case in the future, but in the near term, I think there's still a lot difficulty for the prediction market to become very popular. And you see the project Augur, right? Like they've been in this field for a very long time and raised a lot of money and trying to build the prediction market. But it's not very popular even now. The reason behind that, in my opinion, is because we do not have enough data and enough participants to that market to make it become very usable for the prediction. And because prediction actually is not prediction, it's about a calculated probability based on the fact. And if you have enough database and can acquire real-world data, and you can get a very precise results. But right now, like DeFi is small, blockchain is small, and there's not enough data samples, or not enough participants to that market. So I think it will take a while to attract people to that field. And people always follow the money, right? DeFi, even early this year, is not that popular. Why it becomes so popular recently, I think it's because, people see the token price go crazy up, and there's a lot of enthusiasm over there. Eventually, this is all good thing. It will help to drive more capital in the field. And that's why I think that's the reason DeFi become more popular, because it really bring a lot of capital to different projects. And they start to manage the capital. Then people see it's a very stable market to make profit, and they will come. But if you see the prediction market, I still didn't see that happening right now. There is not enough capital to attract people, and there's not enough. That's why there's also not enough participants. But if you consider option and the future, especially option as a prediction market, I think that may be the first step for the prediction market, because there's a demand for the option to cover the risk, either for cover the risk for people who borrow money, because they have their collateral, and all people, the miners, right? They are mining and they manage their risk for the coins they mine in the future. So you see the popularity of the option market right now. And I think if you classify, option as the financial instrument for the prediction market, I think that will start from there first. But for a lot of others, it's just so difficult, because there's no profitability right now there. So that's my take about this prediction market.
There certainly is a lack of capital, which leads to a lack of liquidity, and that's going to hinder people's ability to make profit. So,
I think overall, like the education too, like the awareness of prediction markets, or even like options trading on open.co, or just being able to get these ideas and overall spread them to more people who would be interested is going to be huge. But yeah, overall, it's a liquidity thing. As we get more people in the space, more things, more money, over all these protocols are going to be stronger, and everything is going to grow as a whole. And that's part of all these new tokens popping up. All the governance tokens and all that. So on that concept, and on that note, there is a private token sale ongoing. Correct me if I'm wrong, Jason, for the protocol of DeFiner. So what's going on there? If our audience is interested in that, how can they look to invest or get more information? Kind of what's going on with the FIN sale right now?
Oh, thank you very much. So Andrews, FIN is DeFiner governance token, and there's several things. People already familiar with the government token of Compound and etc. other projects. The difference for DeFiner governance token is, first, you can also have anything you have for the Compound, like you can participate in the voting, control the configurations of the protocol. That's called governance, right? Another side is the profit. So for the Compound, I don't think they return, their gainings to the community, but we do believe that's also part of the, the value of the token. So DeFiner Fin token, people who owns it, they will also automatically share the profit gains from the protocol itself. That's our unique side, which other protocol they still don't have right now. And also we believe. Go ahead.
I was going to say, that's what I was saying earlier. The concept of paying out the token holders, not only for governance, but a cash flow of the fees that are accrued on the platform is going to be huge for the overall appreciation of tokens, as well as maintaining the network, because it gives people and holders an incentive to continue to hold on to the token. So for anybody who has the FIN token, again, they will be paid out some sort of fee-based schedule off of what is generated on the protocol, correct?
Yes. So in my belief, there's a three pillar. One is this profit sharing, because all the community create value, but eventually who get the value? That's the most important thing, right? And eventually, if we are going to achieve truly decentralized, there are three things you need to be very decentralized. One is this profit sharing. Second, this is governance, control the protocol configurations. Third, also is about this participant incentives, which is the liquidity mining. Compound only have liquidity mining, have governance, but they still do not share any profit to the community. But we do believe in order to achieve truly decentralized, that's also a necessity for the community. And also we believe, we cannot sell product based on the promise. That's why the token sale process is also along with our product development. And our product right now is being through auditing. And we selected the top three, the auditing firms to complete the auditing, to make sure our protocol is very safe. We are
in terms of your smart contracts, right? Is this what you're referring to?
Yes.
Okay, so okay.
Cool. Yeah. Great. In terms of the smart contract auditing, so right now we have completed the first smart contract auditing, and end of August we have the second one. Then September we have the third one. When we complete the first one, mid of August we start to release the protocol and the product to the limited public, and at that time we also want to kick off this private sale of the token, and we believe the early participant or early adopter should sharing the gains of this protocol, and they will be people who have early access to the platform, love the platform, and promote the platform. So they will have the right to participate in the private sale and at a lower price. And then the plan is once we reach, it's all measured by the asset under management or the asset locked in the protocol, right? So mid of August we are going to launch the product, and before it hit 500,000 asset under management, and we are going to close the first private sale, and just for the people who already participate in the protocol, before they hit the first 500,000. So after they first hit the first 500,000 asset locked, we will start the second round. The target is to boost it, because the more people participate and they will contribute capital and gain the profit, gain the tokens, that's also part of their returns. Between 500,000 to 5 million, and we will close the second round. And from 5 million to 10 million, then we start to list it on the either using swap or balancers, but make it public. So that's kind of the journey and the logic behind that, because we believe it's a process, right? People cannot solely rely on promise, but they need to see the product. If they love the product, they will participate that and become the part of the community, and then they enjoy the gains if the community keep growing. So that's kind of our philosophy and the plan.
Awesome. And so where can we go to learn more or to sign up for the private sale? It's on the website, right?
Yes. So it's easy. Just go DeFiner, DeFiner.org, and you can find it in the community section. So that's where you can find the token itself. Awesome.
That's really solid stuff. And I appreciate the explanation of how the sale is going to work and the transparency. Obviously, there's a lot of different opinions on how tokens should be created and minted amongst the first investors and then everybody else who's involved on the main market. So we do appreciate the transparency on that. And I believe Rob has one more economic and technical question here that we'd love to hear you speak about. So I'm going to let him grab the floor for this one.
Yeah, Jason. So you mentioned how DeFiner handles some of the risks that we've seen in the past with DeFi. You mentioned the audits on your code that helps solidify smart contracts.
Mm-hmm.
And then, we've also seen how liquidations can be a big risk, and you help customers handle that by sending out emails. One other risk that seems to be floating around and maybe not a risk, but more of a concern in DeFi. How could we see negative interest rates impact some of the interest rates that are happening in cryptocurrency and DeFi specifically? Does DeFiner have any, safe holds because they are a little bit more centralized than some of these decentralized protocols? Or is there any plan to handle negative interest rates in the future?
The negative interest rate, I think, is determined by the market, right? Like in Europe, and there's a lot of money printed out. And to understand this, I think it's simple. Like if there's no, I call it fake money, which is you don't need to work, you don't need to contribute to this world and society, but you can print out the money as a debt. That's, I call it just a kind of fake money. I mean, if the central bank, they do not print too much this kind of fake money or issue the debt, there's not going to be negative interest. Because like what is negative interest? This means like the money has zero value. I lend you something, I need to pay you, which means it doesn't have too much value in that. And which means at least the people who borrow it, they cannot use it very well. The natural interest rate is not in this way, because money still has its value. It's just because people can control the printing money, the mechanism or the power, and they want to, the boost the economy, and that's how it happened right now. So just think about like in US, like the government issue like $1,200 to people, right? You don't need to work. I mean, if that's the real thing, really help people, like why don't everyone let's stop work and just wait till the government issue the money? Then
and you'd be surprised, there's so many people in America that have been offered their jobs back, but choose not to go back to work because they're making so much money from these checks or from unemployment, and then they're trading their unemployment checks. And there's a lot of crazy stuff when you start giving out free money, like you're saying.
Yes, that's really crazy. But I will say several things can happen if people keep doing this, because it's always about supply and demand. Think about like people work is actually supply, right? They supply the product or service, and people consume, which they spend, which is money. And if they do not keep supply, which do not work, but keep the demand side, which government issue your money, there's going to have inflation risk. So which means you keep printing, but there's not enough product, and the inflation will come. So at that point, then the central government, they are just done. They have no way to solve that problem. But I think then go back to the DeFi. I think the DeFi, right, decentralized finance. The idea of decentralized finance is to avoid to have this kind of central party to printing out the money. I think if DeFi eventually success, there's no negative interest. And otherwise, you just screw up again. Because for the money itself, if the supply and demand, is kind of balanced out between each other, the negative interest is impossible. And the only reason why there's a negative interest because people managing people's demand and they can print out the money, and then there's a negative interest because think about they print out money, they have no cost at all, so they can manage that to meet their purpose. And that's the reason why we need DeFi. And I think that's the reason of the burn of DeFi. Because think about the DeFi is only like 2 years old. And the why we want DeFi at the beginning, because like 𝗵𝗶𝗴𝗵 is very successful issue the DAI, and it's kind of first, not managed by the central organization money issuing process. People very excited about that. Then they start to use DAI. I think if they are going to successfully see the DeFi developing, that will solve the problem which created by the centralized organization like the central bank right now. And that's the reason why in this such pandemic right now, DeFi is so important for the future of the finance. And because the financial world didn't change too much for the past centuries, and the power is still concentrated to the people who are close to the people who can print out the money. And in the DeFi, we just want to redesign that whole process, make it as decentralized as possible. The layer DeFiner add-on is just kind of improve the user experience, but not necessarily change the basic principle. We didn't change the basic principle, which is return the power of the finance eventually back to the people who created the value, not to the people who are printing the money. So that's my take about this kind of negative interest rate.
Yeah. We're trying to make the money more real. We're trying to make it as real as possible. Yeah. Well, Jason, it was a pleasure talking to you. I think we are running out of time here, but Andrew, is there anything else that you had before we wrapped up?
No, that's about all I've got as well. It was a pleasure, Jason. I agree. Thank you so much for all the information that you shared. I hope everyone who's listening got a ton of value about this, and we'll check out the DeFiner protocol. I learned a lot. I'm excited for what's to come. And just a quick little disclaimer, guys. Obviously, we're here to help, to educate. We are not financial advisors. This is not advice. Please invest in crypto at your own risk and do everything and do all your own research on your own. Again, this is Jason Wu from DeFiner. We are signing off, and we appreciate you, Jason.
Thank you very much, Andrew. And Rob, it's my great pleasure to be here and talk to the DeFi Slate community. I will sure you guys will keep growing, because I believe, fully believe we are all doing the right thing, and we are creating the value and make people's life easier. So let's do it together.
There it is. Alrighty, guys.
Thank you. Bye.
Thanks for listening to the DeFi by Design podcast. Until next time, DeFi Slate Team.